Here on Dukascopy TV, we try to bring you a varied and wide angle on a variety of financial subjects. Today in the studio, I'm joined by Mario Geniale, who is the CIO at Banque CIC. Mario, welcome to the studio.
Thank you for having me.
Today we're focusing predominantly here on asset classes, and we have a lovely graph here, which I'd just like us to run through, just to take a look at what investors globally are looking at and what's the sort of hot topic at the moment, if you like. The first thing I noticed here is gold, and we're looking predominantly, first of all, at Europe and Australia next. Let's just have a look at the contrast here between Europe and Australia. Why are Australians here, you can see 62%, why is the general sort of sentiment here for Australian investors so high in gold?
Well, the first thing that you can see is that gold in general is very high. If you look at Europe having 41% and Australia having 62%, that's generally very high figures. The reason, or let's say the difference between Europe and Australia probably comes from the fact that Australia, being one of the biggest commodity producers in the world, probably for the investors there, investing in gold is much closer for them just on a sentimental basis.
Okay, Mario, but I mean, if we look at Europe, still the gold percentage here is 41%. That's still quite high compared to some of the other asset classes. I mean, what is the key interest in gold? Why are some investors so interested in gold at the moment?
Well, you can still see that risk aversion in Europe is very high. Obviously, the economic figures that we had lately were not that good that we could expect a high growth rates in the next year. People are still a little bit worried about the whole debt crisis. Greece is still in the minds of all the investors, and people are looking for safety. For that reason, it makes perfect sense that they are looking at gold, but probably this 41% looks very high in my opinion.
Mm-hmm. Now let's just take a look at so here we've got Europe's. If I just get the Australia, you can see obviously the chart adjusts. Let's take a look at cash now and perhaps bonds. We can see that in Europe, cash is noticeably higher than Australia, and obviously we've got bonds being higher in Australia than in Europe, where there's 6% in Europe, 13% in Australia. Can you talk us through very briefly perhaps why there is a difference here in cash and bonds?
So the high level of cash in Europe, it still corresponds also with a high level in gold. It's still the look for safety, for security. If you look at the low level of bonds, if you look at Europe with 6%, it's obvious that with the current low yielding environment that we are in, that investors simply just don't see any benefit out of investing too much into bonds. We are talking about yields around 1 or 2%, depending on what kind of maturity we are talking about. But if you look at the Australian bond market, their yields are still much higher, even though that now that the Royal Bank of Australia has just reduced their benchmark rates down to 3%, to the lowest level in this year. But still, over the curve, you can still get some nice yields in Australia, in Australian bonds, around 4.5%, and therefore it makes perfect sense to invest in Australian bonds. But European bonds, as I said, for the time being, there's a high risk that at some point yield starts rising and you would start losing on your bonds on the prices. Okay,
and just looking finally at a touch on real estate over there by you can see we've got Europe's at 19% and Australia 10%. Why do you think investors have voted that way?
Yeah, there once again, I think in Europe, real estate is often associated with safety. It's something that you buy on a long-term basis. It's something that gives still a nice yield. In Europe, we're talking about easily about 6, 7, 8% yield that you can generate on real estate. If you go over to Australia, if you look at the house prices there, what they did in the last years, they have gone up quite substantially over the last years, and it's very clear that people now are a little bit more afraid that the house prices won't go up much further or even go down, and that's probably why all the Australians for the time being are a little bit more on the cautious side for the housing market.
And of course there's the problems as well in Australia with their economy at the moment, in China, and there's an issue with trade there, so I can imagine that also affecting some people there and perhaps affecting the real estate market. Mario, one last question, okay, which we call a Dukascopy question. Okay, now if you had $1 million out of these classic classes, where would you invest in right now?
Right now, I would probably invest in the equity market. Even though that we think that over the course of the next several weeks, probably the equity market will go a little bit lower, we think that 2013 is going to be a good equity year. We think that equity market will go up, that at some point the economy will gain traction again, but that's going to be in the course of the first quarter. And we think that during the course of the first quarter, the equity market will go up. What we see is that the big companies in the US, they have piles of cash. They're sitting on piles of cash. I think that the US is sitting somewhere around, the big companies sitting around somewhere about 2,000 billion of US dollars of cash, and this money has to be invested at some time. So we think that as soon as we get some security in the economy, that the US companies will start to reinvest, capital expenditure will go up at some point, and that is something that we will start be seeing in the equity market in 2013 into the year end.
Very interesting. Thank you for that, Mario. Ben, your choice equity, it seems that Europe's and Australia is still very much gold from this chart, but thank you very much for joining me in the studio. That's it from Dukascopy TV for now. Some interesting points there by Mario Geniale. We'll be back again, though, later today and throughout the rest of the week with the latest updates and interviews. But for now, though, goodbye.